Hello again. This is a midweek update to the session we had on Saturday that went over the extremely high and extremely low movers from the week ending March 7th, 2028. I hope you enjoy it. It has, borne some analysis, so I tend to analyze over the weekend, make predictions on how the stocks are going to go for the next week or two. It's not a deal for day traders, it's more for investors and swing trading. We look at uh, again, outliers. Outliers are good for scalping. Scalping means we believe a stock kind of got too big for its britches. People had a FOMO experience when they noticed the stock went up about 5%. The fair value was at 5%, and the stock went up to 10%. We would apply Fibonacci retracement to say if this is a healthy move, the 10% should go down to 5% and continue up. If it was kind of impulsive or erratic, we'll notice it by whether the Fibonacci retracement was more like 33 or below 50. But 50 is where you want to see the retracement go to. It's a healthy move. It's an opportunity to scalp, meaning the opportunity is evidenced by statistics and it'll happen. But if it happens before you notice the stock even went up, it won't make the news right away. So the stock like eBay last week, that I think went up phenomenally, is something that I was able to scalp, and I'll show you how we did that. So to recap, on Saturday we looked at the movement of stock over the course of 7 days from February 28th to March 7th. It's about a week and a half of trading, 6 or 7 days. I wanted to see, hey, how did the stocks perform over the past 7 days? I looked at the top, so maybe looked at 200 or 300 stocks on a watch list. Said, let's take a look at the top 10. How did the top 10 do? Were they getting too big for their britches and causing perhaps a scalp opportunity? Inversely, were the stocks oversold out of fear and getting ready to rebound to a more moderate level? In theory, there is a rationale because those of us that have delved in math and analysis and statistics will tell you that the stock market is often, exhibiting real traits. Those real traits are movements towards averages. So a stock perhaps that's kind of out of its normal range is out of its normal range and will go down to its normal range. Even if in general it's going up, I use the outliers as an indicator of when a stock's average is going to move because the outlier is going to make the average move. However, the stock price itself tends still to go toward the average. So really what you're looking at is analyzing price action based on, big moves to the upside or downside. Conversely, I'm looking at stocks that are flat because stocks that are flat just aren't going to stay flat. They're either going to go up or down. That gives me an opportunity to focus on this. So even though I like to talk about the outliers because they give me a scalping opportunity, the ones that are even meatier are the ones that are flat. I don't care about the 1% moves. They're generally trending. They're not going to give me a lot of money. 2 and above, okay. I really want the outliers, the ones that are flat. This is just a review of the methodology we went over on the weekend. I'm looking at closing price 7 days ago, and today, that's where I'm getting the breadth and depth of moves. So I appreciate you watching this. Well, we concluded last week on the first watch list of mine that there were cannabis stocks, gold mining stocks, and what amounts to short stocks. I may have had a typo on there. I may have said that the SQQ, which shorts the tech ETF, went down. I meant to say it. It indicated that the Qs were going down, not that the SQQ or the inverse Qs ETF was going down. The inverse Qs went up by 11.7%. And because they went up, I meant that the Qs went down. So forgive me for that confusion if you saw it. Long story short, we said this week we're going to analyze eBay. And again, this classic example of where I see a stock that in a bear market of all things went up 9%. Can that hold on? Can that continue to grow? And I said, not only do I need to check Fibonacci retracements over the next week, I need to look at it on a daily basis. And In this video, we're going to go ahead and show you the recommended trade and how it's already come to fruition. Or now we'll take a look again at those stocks that appeared to make larger moves to the downside for the week ending March 8th, 2025. This is Eddie. Hope you like my channel. The reason we're looking at stocks that move in extremes is because stocks inevitably tend to move toward the mean. So anything outside the 5% range might be viewed as a what amounts to zealous FOMO event where people saw something in the news, more people saw something in the news, and inadvertently, you know, gobbled up a stock beyond what it was fairly priced at. So the result will be that people that had owned the stock previously noted that there are profits to be taken. Many conservative hedge funds, maybe many conservative investors will say, "I'm going to clear out half of my positions for a healthy profit because the rate of return, is what I was hoping for over several years. 10% move is something you'd want to try to get in a couple of years, but here I'm getting it in a day or two. Well, of course I'm going to sell out." So that big move generally isn't going to end well. It'll continue to be tested. That price will be tested over time, but it's not going to end well right away. In fact, healthy moves are known to retrace. So inversely, the same is true. Stocks that go down by a precipitous amount are more than likely going to revert to the mean um, because of that fear. People get fearful because they've read something in the news, but they know that they don't know that bigger institutions are going to gobble it up at a price that they consider fair value. So if a stock has been going down again 5 to 10%, and it's being sold at a price where they had invested in it about a year ago, then of course they're going to double down on it because they don't believe the stock is going to go down much more and will eventually rebound. Again, thanks for watching. This is Eddie. The big one here that I'd like to discuss in more detail, of course, is NVIDIA. NVIDIA was down 15%. Um, and at the time of this video, we're going to revisit NVIDIA and see how the price compares to 129. We're also going to see how the price compares to those bigger moving stocks, and particularly eBay. And for fun, we'll look at my favorite here called Vistra. And obviously, to satisfy those that are really zealous, they probably have a huge interest in the Reddit stocks or the very popular stocks that people are talking about. Delta Airlines, United Airlines, those have been hit heavily. And again, the decline suggests sooner than later those will rebound. So really, there's a feeding frenzy for sharks in the water because uh, eventually stocks are going to turn around, and some of these really beat up stocks are the ones that are probably going to more than likely make moves first. If you like being first, you'll want to know about the airlines. I'm less concerned with the obvious. I'm looking at um, stocks that are less obvious because those that are less obvious um, probably will make greater moves because less people are talking about them, and it'll probably be a structured thing where it's easier to predict the structure. So I'm really looking at rational trading, not spontaneous combustion, which is stocks that are too popular, too wild, and kind of like your buddy or your girlfriend's moodiness. You definitely don't want to be there for that. You know what I mean? Okay, enough of the jokes. Again, we're looking at eBay that went on the upside, and we're looking at Nvidia and Vistra Energy on the downside if we have time. Those hypermanic airline stocks. So what I did is take a snapshot of the charts. I'm going to tell you, obviously, The chart itself looks healthy. I'm going to go from left to right, from February 27th, where the price was trading around $63. This is, I think, the half-hour chart. So there's an hour, 2 hours, 3 hours, 4 hours, 5 hours, 6 hours. So, so that's 27th. 28th is a Friday. Monday, Tuesday, Wednesday, Thursday, flattened out. Looked like it shot up between middle of Thursday and Friday. So that's why it came up on my watch list, because by the end of the day on Friday the stock had shot up. Sometimes it does crazy things on the end of the week. It had shut up. On the weekend, we said this is what it's doing. I said it's probably going to retrace 50%. A 50% move would be about $5, so I wanted to retrace around here. I placed the trade on Monday morning. It immediately went down, okay? That's kind of cool, okay? By the end of the day on Monday, it had retraced to that Fibonacci level, which is to say, 63 to 71 is $8. A healthy retracement would be down to 67. 67 is right here. So uh, we're well on our way to making money because I bought it here. A scalp is I'm going to short it. If you don't know what shorting is, you need to go to your local site and figure out. But shorting was a good idea. I'm in the position still. It's a swing trade, and to be fair, this is where we are today. So it doesn't look like it's going to get much shorter. Um, due to my due to my particular strategy, which is a covered vertical put, I can't really make much more money because I effectively said I'm buying this put, which is now nearly completely in the money. I think I bought it down here. I think I'm going to sell it, but I had sold the 63, so the maximum profit I could take on one trade is about $100. I think I paid $10 for it. That's do the math. That's how money's made on the stock market. Let's assume I bought $10 contracts for 100. I made $1,000. Okay, this is not playing around. Statistical analysis and watch lists matter. I urge you to watch this channel for more educational videos so that you can feel confident, and we'll track stocks together. So on Saturday we said let's look at the price. Should we decide to enter the short? Remember this, the stock was trading at $70. Um, the stock at the Fibonacci retracement we said would have been down to 67. $67 put because the stock is moving in the up direction. The algorithms, mathematicians are saying it's going up. So the price was going to be fairly cheap. It was going to get It was $20 to get into the put for 67. Okay. Um, $20 to get into that put. The payout is basically 80 bucks. All right. So for every $20 that you put in, you were going to get $80 in return. The stock is trading at 67. This is the actual ticket. The estimated amount to get in was 7 because I didn't really just take the put. I said I'm going to fund the put by selling this. I was going to buy I was going to buy the 66 put, get out at 67, fund it with the 67-68 spread. That's a topic for another day. Okay. I'll maybe do a topic on the pricing over the weekend, but this is the actual ticket. There were 7 million contracts on that, it looks like. Again, you got to have a watch list. You have to be strategic. You can't just willy-nilly bet on the stock market. You have to analyze it. When the moment is right, you get in. Now, let me tell you, I didn't get in at $7 on this. I got in at a different price because I wasn't the only person who probably thought it was a good idea to do what I did. This people probably sat down over the weekend. This price tripled. Okay, which is still okay, $20 for I think I got it at I don't remember what I got it at. But it tripled, okay? Because I saw it. I was sitting there trying to get into it. The price kept going up and up and up. And oh no, what's going on? Which means the interest went in on it. But this is what, if you had been able to get into it at the end of the day, which is very hard, you can't be that spontaneous. You got to do the analysis. I got in at the beginning of the day, and that price, if you had gotten in at this, you'd had a return of 10 times. So $70 um, would have been turned into 700. Okay. Hedge funds make money like that, 7,000, 70,000. Do the math. It's unbelievable when you do your analysis. It really is. Really, truly is. Okay, we said NVDA had been doing kind of crappy, right? At the end of the day on the 7th. And at the end of the day on the 7th, I mean, it was trading at around 112 bucks. So, Monday freaked people out because it opened lower, it went down, down. It just went right down. Okay. So once it started flattening out, you might have been inspired on Tuesday morning. By about mid-morning, you noticed the stock was going up. Okay. Again, the very aggressive investor would have made a play right around there to the north, and it did go north. It went north. It's going north. It's probably tomorrow's probably a super important day for NVDA. What I'm teaching in my room is you've got to hedge your bets. If you're going to make a bet in the beginning of the week, you just got to make the bet. So if you had made the bet here, you probably would have tried to do what I call a hedged position. So you would have said, I think this is going to go north. I'll open a position to the downside and I'll open a position to the top side. So you would have made money on both ways. I still think that's a smart move tomorrow. But I just, you know what? I don't have time and money to bet on everything. So you got to lose the FOMO by just focusing on one or two things in addition to what you think you'll get FOMO on. What everybody gets FOMO on is NVDA and big stocks. So in order to reduce that, just get into it at the right time or stay out. Right now we stayed out. We definitely missed out. If I'd gotten in on a trade down here in the positive direction, which some people may have, might have made a little bit of money on a day trade, not much. The swing trader would have made money because he held overnight. And that's what I'm trying to teach people. Try to make your trade at the end of a day if you're really, really smart and agile, but do it at the beginning of the day to be safe. So if you had thought you were near a bottom at the beginning of the day and held, you would have gone up. Okay. We haven't missed out on Nvidia, but we just don't know what it's going to Yeah, these videos, these midweek updates and weekend updates are not trivial. Okay, they're super important. If you're tossing and turning and you found this video at night or you found it in the middle of the week, it's very important because look, we're going to visit this slide here on United Airlines, and what I'm trying to tell you, it's not a joke. United Airlines, okay. Um, Sorry, the ticker is missing because that's the way the stock is presenting. Um, let's see. Now might be the time to get into United Airlines because the stock, okay, United Airlines is trading at 72.46. The daily chart says it's gone down even further than what we've seen over the week. Now we looked at it on the weekend and we said on the weekend this shit's gone down. Pardon my French. This crappy stock has gone down. Okay. At the end of the day, at Friday, it was trading at around 80 bucks, and that's a precipitous move. Um, you see, $80 for the United Airlines stock. If you look at $80, which is on Friday, and where it was trading at 100 minus 20 is a 20% move. 80 to 100 is a 25% move. 25% move to the upside on United Airlines. Give me a break. Okay. I'm not telling you what to do, but now might be the time to consider going long on stocks is what they'll tell you. Okay, now this isn't financial advice, but what I teach myself is if there's a period of flatness like there was today and decreasing lows, if you believe you're close to value, meaning why did it go down? Okay, meaning somebody decided to start selling it 85 bucks, you're at $70. So they, they anticipated a move of 20% or 15 or, over many years. So they said $85 is a good price to sell. $72 is where people will get in if they're going to get a return to 85 by the end of the year. So over 10%, 15%. There's no question that I'm looking to buy this and go long. I'll have more on the weekend.